Before we move on to our video, let's look at the disclaimer/disclosure clause. The contents of the video or presentation are for information purposes only. The material is been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 35th of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial/total loss of investment. The idea and opinions in our video are solely based on our analysis of the market, and we do not advise/recommend guide anyone to take any trade based on the contents of this video, and we do not take any responsibility for partial/total losses arising out of trades based on the contents of this video. Ladies and gentlemen, traders and investors, a very warm welcome to our channel Vega. On today's video, we shall talk about strategic nuances required for coherent maintenance of financial and economic objectives while navigating through volatile and turbulent market conditions. Markets can see seismic moves with the release of unexpected information relating to geopolitical conditions, which could be the result of data input not baked into the value of the affected asset class. Since the prevalent conditions are showing a lot of uncertainty, it's going to be difficult to statistically determine precise entry and exit levels in the current market conditions. Tactics used while trading markets in turbulent conditions should always price in the probability of getting stopped out as a result of shocking market moves. This can be achieved with the help of constantly moving/trailing stop losses if the trade is moving in our direction or favorable direction, and exercising absolute caution and getting out of the trade if the trade is showing signs of reversal on a lower time frame. Dependence on long/medium term indicators like moving averages or RSI or stochastics should be avoided, and adherence to basic trading strategies concentrating upon the candle formations in real time should be followed to make quick decisions. This may lead to some loss of profit if you get stopped out or quickly come out of a trade on a false signal, but it may prevent huge losses occurring or whiplashing moves making the price gap up or down against us on the instant release of unfavorable news. Oil prices have been going ballistic ever since the US-Israel-Iran war started, and one should avoid getting into oil trades when the trading volume is thin or if the market is going to close for a trading session or weekend. If someone is placing a trade, buy or sell, either way, then the trade needs to be physically managed or can set up tried stop losses. And if the trade is being algorithmically monitored, then the stop loss limit should be as thin as possible. Although the week opened on a huge gap in the oil market and a gap down in this gold and silver market, but the direction of movement immediately reversed when the President of the United States of America extended the 48 hours of deadline to 5 days. There were different sorts of rumors floating around in the market, but as disciplined traders, we should concentrate on candle formations and the patterns established in real time in front of us rather than making news-based decisions. Over and above oil, metals, USD, fertilizers and other such commodities dependent upon the transit of vessels through the strait, or those dependent upon gas/oil prices, are the ones whose prices have seen an escalation in the last 3 weeks. Since Iran has been using the strait as a tollway, making millions from ships passing through the strait, the energy prices in the near-term future will price in these expenses. Overall, the current scenario is looking at elevated price conditions, which the current market may not have extrapolated. Whether the market is going to stabilize or the conditions remain the same is dependent upon the condition of the war coming to an end, or is it going to continue further. If the war is going to follow an escalatory trajectory, will depend upon the role of the United States of America in the forthcoming week, and one needs to see if the warring nations can find a diplomatic solution to the ongoing conflict. Small-time retail traders may need to bring in strategic nuances and tactic modulations while navigating through these volatile market conditions. On today's video, we shall talk about DXY, the US dollar index, US oil spot, silver, gold, S&P 500 and the Nasdaq. Ladies and gentlemen, traders and investors, the chart that we see in front of us is that of DXY, or the US dollar index, and it is the daily chart. US dollar index, as we've seen in the last few weeks, and over the last few months it has been in a sideways trend, and although it had a chance to break out of its range from the momentum that I gained in the last 2 weeks, it hasn't been able to do so up until now, and it's still being held by its upper bound, which is at 100.391, and there is a nice seller's area right above this particular limit that it has not been able to cross, which is between 101.07 and 101.88. We need a nice strong momentum for the US dollar index to break out of its range, otherwise it could still reverse back and go to its usual sideways trend between 95.45 and 100.31. Its strength is going to affect many other asset classes, particularly the metals and the currencies, as well as the indexes and the equity markets. However, we need to wait and watch to see how news plays out and how it helps this particular asset class to gain enough strength and momentum to break above the area of 102. Fellow traders and investors, the chart that we see in front of us is that of XAU/USD, and it is the daily chart of the gold-based ETF. We've been visiting this chart for the past few weeks, and it has been following our estimated projections as we move through weeks and conditions that are being affected by the current geopolitical situation. Gold originally had been in an uptrend up until January or end of January. It then came down in the first week of February to print its first low, which touched 4400. It then printed some higher lows, and then it printed a lower high which was below its original or its initial high that was printed in the month of January, and this is the all-time high which it printed in the month of January. But then it printed another lower high which is in the area of 5127, and as of now we see that it has also printed another lower high which is at 5000. Now for this particular area to work as a controlling bearish area, it should have printed a complete bearish candle last Monday, which it failed to do, because although the candle was red, but it touched the area of 4100 or slightly below 4100, and then it reversed all its losses to print a bullish candle. Therefore, although a downtrend has been established in this particular asset class, but we've still got a bit of sideways movement. And as of now, if you look at the 4-hour chart, we can see that there is a higher low printed above the low that it printed on Monday. And if you go further down on the 1-hour chart, we can see that it is in the process of forming higher lows on the 1-hour chart, and it needs to break out of the area controlled by the candle at 4600 to continue reversing its losses as printed in the last 1 week. However, since the asset class is in an established downtrend on the daily chart, we shall not be going for any bullish trades or any long trades. As of now, we shall wait for the candles to reverse back into the area of 5000 and wait and watch if it's reversing from this area or does it go further up into the area between 5147 and 5200 or even higher, that is at 5399, which is the second lowest high since the original all-time high established in the month of January. Therefore, we have got three controlling lower highs in a row, and this could prevent the quick reversal of the gold-based ETF, and we can still go into a short if it comes into the area between 5000 to 5400, but we need to wait for signs of reversal on the lower time frame, which will be the 4 hours chart or on the hourly chart. It's these charts which will show us if the asset class has come back into our area where we'd like to go short, and if there has been a reversal in any of these areas. The chart that we see in front of us is that of silver based ETF. It is XAG/USD and it is the daily chart that we're looking at. The silver chart as of now is slightly different from that of gold, and it's got a stronger downtrend as compared to gold. As we can see that similar to gold, it printed a bearish candle on Monday, but it reversed all its losses and finally there was a bullish blue candle that was printed on the same day, and then it was followed by another blue candle, and then there is a strong reversing blue candle as we can see that is currently stopping or taking out all the buy orders. There are other bearish candles while following its downtrend from the area of 90 all the way up to 67, and last week it touched a low of 61.30, but there have been some bullish moves purely under the influence of news. However, the bullish candles or the buy orders have not been convincing enough to take out all the sell orders that have been lying in the area of 71 to 80, which once upon a time used to be a support area, or up until week before last it was an area that was preventing the formation of bearish candles and it was taking out all the sell orders. As of now, there is a chance that if silver manages to break below and close below 60, then we shall go into a very strong downtrend, and the next area which could be a support area for silver would be between 50 and 53, which is the psychological area, and there could be some buy orders that could prevent or at least temporarily stop the downward move for this asset class. However, if it manages to go down and close below 45, then there are no explosive areas which could provide a support for this asset class. Traders and investors, the chart that we see in front of us is that of Nasdaq or VNQ, and it is the daily chart. As discussed during our presentation last week, this particular asset class has managed to form two explosive drops on Thursday and Friday of last week, and it has also managed to close below the buyer's zone between 23497 and 24137. As of now, it's trading at an area which was a resistance area and has now been turned into a support area, and this is the line, the red line that we can see at 23217. It has managed to close very close to this particular area, and if it gets momentum with the help of news, it could print further drop candles and could take out the next buyer's area, which is between 22243 and 22794. That's the next buyer's controlling area. However, as we can see that the asset class has managed to form lower highs consistently in the last 3 weeks, and we are in a confirmed downtrend as we speak. The downtrend is just begun, so there is ample amount of scope for this asset class or this ETF to drop all the way down to the area of 19,000 or anywhere between 18 to 19,000, where it can find some explosive green candles that could help the asset class turn around. But as of now, there are no major buying areas anywhere below 23,000 all the way to 19,000. So if one tries to enter a short, they have to look at getting back into a nice seller's area on the lower time frames, which could be the 4 hours chart or anywhere below that particular time frame. But an area which we can see on the 4 hours chart is 2385 to 239 or 24,000. So one can go for a short between 23800 with a stop loss above 2400. We can be as generous as possible at this point of time because the market is very volatile and the news could give rise to whiplashing moves. However, we have, as we can see, this area used to be a support area once upon a time, has now turned into a bearish area with a recent lower high formed there, and that's where one can short if at all the asset class manages to print some rallies into that particular area. Traders and investors, we're now looking at the S&P 500 or the ES chart, and it is the daily chart that we're looking at. It is almost similar to that of Nasdaq or NQ, except that it has had a steeper drop during the last 4 weeks. As we can see that it used to be in a sideways trend up until the beginning of March, and then it has managed to print 3 conspicuous lower highs, and it hasn't closed below the supporting candle between 6412 and 6550, as compared to Nasdaq, which has broken below its lower support and is now trading in a nice bears area. In case of S&P 500, we need to break below this red line, which is 6381, and then if we want to go short, we need to go into a seller's area which is going to be somewhere between 6536 and 6580. That's the closest area where one could go short. But again, one needs to be generous at putting your stop loss, which could be anywhere in the range of 6600 or between 6580 and 6600. But however, we need to first see this particular trend break below 6350 and close below 6350 before it goes back into our seller's area. Traders and investors, we hope that our presentation has been informative and exciting enough for you to come back and watch all our videos every week. We shall continue with our weekly commentary and be touching upon events which were the highlights of the week. We shall also talk about interesting asset classes each week. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle at Polo Vega. Please keep saving, keep investing, and keep getting wealthier until we meet next. We thank you for watching our video. Please like, share, and subscribe to our channel Polo Vega.